The financial world just took a body blow. Federal Reserve Governor Robert Kagler's sudden resignation detonated a wave of uncertainty that erased more than $1.11 trillion of value in a single trading session. Wall Street went risk-off, algorithms yanked bids, and crypto followed in lockstep. Bitcoin flushed to roughly 113,000, Ethereum slid toward 3,500, and nearly every major altcoin printed double-digit intraday wicks. XRP, which only days ago was grinding above $3, is holding a nervous $2.95, clinging to psychological support while liquidation engines chew through late-cycle longs. Why did one resignation cause such carnage? Because it arrived at the worst possible moment. Congressman Thomas Massie has spent the past week on cable news arguing that the Fed itself should be dismantled. His bill has little chance of passing, but the conversation alone is enough to rattle credit desks that rely on the central bank for overnight liquidity. Hold its safety net, even hypothetically, and treasurers yank risk faster than you can refresh a chart. Into that vacuum steps Ripple, quietly ticking off every regulatory box a would-be clearing institution needs. Months ago, the company filed for a U.S. banking charter. Weeks later, it applied for a master account at the Federal Reserve, the same privileged gateway that lets large banks settle balances directly on the central bank's ledger. David Andolfatto, former research director at the St. Louis Fed, has already gone on record saying there is no technical reason the Fed must run its own clearing rails. A private entity could handle settlement if it met stringent audits and capital rules. He even named Ripple as a prime candidate because its tech stack is purpose-built for instant, final settlement. Ripple's architecture is tailor-made for the role. Ripple Dollar provides a fully reserved, regulator-blessed stablecoin for domestic clearing, while XRP acts as the neutral bridge asset for cross-border hops. Payments that now crawl through correspondent chains during business hours would compress into a single atomic swap. Dollars in, XRP across, local currency out, settled and reconciled in 5 seconds, 24 hours a day. Banks would still hold reserves, but liquidity buffers could shrink because capital cycles back in near real time. From a systemic risk angle, that is the holy grail. Lower daylight overdrafts, fewer settlement fails, tighter spreads, and auditable on-chain transparency. Critics counter that central bank sovereignty can't be outsourced to a private ledger. Yet the Fed already relies on regional reserve banks, private clearinghouses, and even custodial giants like BNY Mellon for critical operations. Delegation is a matter of statute, not sacrilege. If Congress ever decides to overhaul the plumbing, it will look for a vendor with live corridors, institutional partners, and regulatory head starts. Ripple checks each box. It has NYDFS approval, Singapore's MPI license, and corridor data from remittance giants like Tranglo showing billions settled with pennies in fees. Zoom back to today's market route. Futures funding hit extremes as traders who bet on a post-FOMC melt-up got steamrolled. $800+ million in BTC longs vanished. ETH perpetuals saw similar carnage. XRP liquidations were smaller in notional terms, but proportionally brutal. Yet something curious is happening beneath the surface. Whale wallets, the ones holding 10 million XRP or more, are net buyers on every dip this week. On-chain analytics show exchange inventory falling even as price chops sideways. That is classic smart money accumulation. Use panic wicks to reload, then wait for catalysts like the SEC's August 15th brief or Congress's September vote on stablecoin oversight. Banks appear to be preparing as well. 4 Tier 1 institutions have posted job openings for DLT settlement specialists within their Treasury Ops groups in the last 48 hours. 2 explicitly mention experience with ISO 20022 messaging and emerging liquidity bridges. You don't hire that talent unless you plan to plug into a network that already speaks ISO 20022 and offers a liquidity bridge. That description fits XRPL today, not theoretical CBDCs that are years from rollout. Even Jamie Dimon, who once dismissed Bitcoin as a fraud, now admits blockchain is eating settlement. He told a recent analyst call that stablecoins will force banks to compete on speed and cost or risk losing payments revenue entirely. Sure, he framed it as an opportunity for JPMorgan coin, but the takeaway is the same. Ledger Tech is heading for the core, not the periphery. With the Fed governor gone and policymakers openly questioning the central bank's role, the speed of that migration may accelerate. What happens next? Watch the master account application. If Ripple secures that slot, it graduates from fintech disruptor to systemic utility overnight. Monitor daily close levels. XRP needs to finish above $3 on the weekly to keep momentum alive. Keep an eye on September's legislation. If Congress codifies a path for bank-issued stablecoins with real-time settlement, Ripple Dollar fits like the missing puzzle piece. And track Fed staffing news. Any hint the board will fill Kagler's seat with a pro-innovation voice could flip market sentiment before charts can price it in. The resignation may feel like chaos, but markets crave new frameworks. Old plumbing is creaking, politicians are questioning mandates, and technologists are offering instant, auditable alternatives. Ripple stands at that intersection, armed with legal clarity, a two-asset design, and a seat at November's Swell Conference where BlackRock, NASDAQ, and Citi will all be in the room. When institutional capital sees both the regulatory green light and the operational savings, adoption can flip from incremental to explosive. Today you're watching price candles bleed, but step back and you'll see foundations being poured for an entirely different settlement regime. One where XRP ferries liquidity the way SWIFT ferried messages for 50 years. If that regime materializes, Kagler's resignation won't be remembered for the fear it sparked. It will be remembered as the spark that pushed lawmakers and bankers to choose a faster, cheaper blockchain-native path. And Ripple, already knocking at the Fed's door, will be ready to walk through.